That was such an interesting chat. We're doing a bit of a topic change over to Kevin March, who is a founder of Jpeg Trading. We're going to learn more about how crypto trades actually work. Round of applause. Thank you.
Thank you so much. It's hard to follow Caitlin Long, right? She's a legend. And to get up here and talk about DeFi, which is where all of us want to play, she really deserves a shout out because she's fighting on the inside of the system that we're all trying to convert. So yeah, shout out Caitlin Long. So we set about answering this question of where and how crypto actually trades. Everyone thinks that crypto is so transparent, that blockchain is so transparent. But the problem is there's so much data that we're working with that it's really, it makes it very difficult to actually get insights out of it. Over the last week or so, we set out with about 300 questions that we drafted, with data that we've aggregated across 30 different chains, in 32 agentic research cycles, which I threw in just for fun. And this presentation is mostly drafted with the research that they put together. And the idea is that if we can grok the entirety of the blockchain data, what can we actually find in it? And there was actually some really interesting findings. So let's dive in. There are a few notes on the methodology here before I take you actually into the insights. First and foremost, as I just described, there's heavy use of AI in the research that we did for the data itself. These slides I made by hand because I'm old school, but I don't want to take away from the fact that this data might not be perfect. We will clean this up and we'll post it publicly. And if anyone wants to engage with us and help take this research forward, you'll be able to find all of the data posted to our Twitter. Secondly, for data sources, we pulled a lot of this from Dune Analytics. Part of it came from our own internal data as well. Also CoinMarketCap, DeFi Llama, and a lot of the project documentation for a bunch of the various projects that we're going to talk about. Lastly, the data that we pulled for this is from approximately September 1st, 2025 to today, as of like 8 a.m. this morning. So this data is very recent. Now, with that being said, we're going to bounce around between a bunch of different insights. Our goal was not to cohesively answer the entire story of what actually drives the crypto markets, because if anyone tries to answer that for you, they're probably wrong. But our goal is to set people up where they can take things forward from what we've done so far. So we're going to bounce around a little bit. It might feel a little bit disjointed. So hold on to your britches, because we are jumping in. Now, first and foremost, bot empires rule DeFi. We all probably intuitively know that, but the question is how much and why? We set out actually to study really broad user behavior. But what we found is that there are a few clusters of addresses that engage with so much DeFi, and they touch so many assets across so many chains that it's almost guaranteed that if anyone in this room has ever used DeFi, you've interacted directly with some of these addresses. So let's start with those first. There are two addresses here. The first of which is 0x632. So this address on the left, this is their cumulative activity over the time period that we measured. They're running a yield farming strategy. They're touching pretty much any DEX in existence across, I think, 15 different chains. They are farming anything that has incentives that are pushed out by any token issuer. They're constantly rebalancing those pools. They're maximizing their ability to extract those incentives. And it's turned them into single-handedly one of the largest addresses that's engaged with DeFi over the last 6 months. They're also related to a second address, 0x278. Which is running an HFT strategy that is rebalancing across a bunch of different chains for a multi-chain arbitrage strategy. In these two chains, a single entity, are single-handedly 7% of DeFi over the last 6 months. There's a third address that we found, though, that's unrelated to those, called 0x51C. We'll post this on our Twitter. I'm not going to read it to you every time. But they're similarly large. And these three addresses, in total, pretty much dominate DeFi. Any chain that you've interacted with, any DEX, any LP pool, pretty much any asset, as long as it's on EVM, it's been touched by these folks. This one is a little bit interesting, though, because they're relatively dominant on Unichain and Inkchain, which I imagine probably not the entire crowd is day trading on those addresses. But these three combined actually represent more than 10% of the entire market. That last address that I was just talking about, 0x51c, this is a representation of their trading activity over time. And the same sort of macro events that drive the volatility that kind of all of us shy away from, that causes a lot of people to stress out and lose sleep over their day trading activities, that's where this thing finds most of its profit. So when the rest of us are recoiling because crazy movements are happening in the market, from the US election cycle to Trump announcing tariffs, that's when this address jumps in. And from that, these folks have pretty much single-handedly cornered the DeFi market. This is the table summarizing, but we can skip it. So next up, instead of looking at individual addresses, what we're looking at are there insights that we can pull out about individual protocols or patterns in the usage activity around these protocols that can drive interesting discoveries that hopefully we can use to design better protocols in the future. First up is Fluid. Fluid as a DEX is probably largely unappreciated. Fluid has kind of had its moment over the last 6 months or so, but Fluid is pretty dominantly preferred by the institutional users in crypto. What that means is that their average transaction size is much, much, much larger than the average transaction size you see across the rest of crypto. Pretty much like any chain you look at, any DEX you look at, Fluid dominantly is the one that is most preferred by institutional users. What they have that drives this is their unique debt liquidity model, which I don't have time in this presentation to dive into exactly how Fluid works, but the usage data around them indicates that they're loved by institutions in a way that nearly no other DEX has achieved. Not Airdrome, not Uniswap, not Meteora, pretty much no one. The next step that we found is that activity on each chain is pretty consistent. So in the top left that you see here is the whale versus retail volume share. And what we're trying to indicate is over time, how much activity is made up of certain users consistently. In the top left chart, Ethereum pretty consistently represents 90%, or the whale activity pretty much represents 90% of activity on Ethereum. The next up is Binance Smart Chain, which is a little bit more volatile. And then Arbitrum and Base. Base is actually really interesting. So across each of these three charts, Base is pretty much the only one that consistently has some sort of volatility to it. And really what that means is there was something that happened on Base on approximately January 20th that fundamentally changed how people interacted on Base. And really it was driven by an enormous amount of retail activity that dwarfed the amount of whale activity that happened on Base on that day. Which, unclear what exactly it was. But largely, each chain has its own personality. I think that's the most important takeaway. That if a certain type of user is dominant on a chain, it's very likely that type of user is going to pretty much exclusively engage in that activity on a chain going forward. Next up is the Solana token factory. Now, a lot of people have talked about the meme coin era on Solana and how it has driven the on-chain activity for Solana for a very long time. I think the surprising thing is that the Solana meme coin era is not over. In fact, it's better than ever. Since January of this year, so year to date, there have been 1.3 million new meme coins launched on Solana, which means that for every meme coin, there are 2 active users on Solana. It's a 1-to-2 ratio. So yeah, thank you for that. So me and whoever just laughed, we can share our meme coin, and then everyone else can share theirs. It's still dominantly what drives activity on Solana. Pump Swap, so Pump.Fund's new DEX that they've launched, is still dominantly made up of meme coin activity that comes out of this. It's still the casino-style distributions that you'd expect. So this bar chart on the right is showing the outcome of each meme coin that launches. So obviously 87% end up with a market cap of sub $1,000, 12%, 0.5%, 0.4%. It drops off dramatically. So it's very much lottery-style distributions. If you see a meme coin launch on Solana, you actually have a better chance of winning the lottery in most US states than to pick a winner out of the meme coin madness that's happening on Solana right now. Despite that, it still drives the majority of on-chain volume. Next up, we had a question, which is, if a very hyped project has a ton of activity on testnet, what does that actually mean for the future usage of that project? Now, I think intuitively, a lot of us could guess that the answer is that it wouldn't necessarily lead to long-term usage of the project just because it has a lot of testnet usage. But we don't want to test it. I redacted this because I don't want to publicly FUD these projects quite yet until we validate this data further. But we pulled 2 projects. We pulled all testnet activity for both of them, and then we recorded those transactions over time. The project on the left, what we found was that it built up to a crescendo, obviously right before it launched to mainnet. And the second it launched to mainnet, it was I think, an 86% drop down from testnet usage to the production usage that matriculated onto mainnet. Hype testnet 2, for a very similar project, followed a very similar pattern, except at least it had a slower drop down from the peak into the lows that happened post mainnet. But still, it was a 95% drawdown from the peak testnet activity. In both of these cases, there were no clear incentives that were being thrown out for testnet usage. It was more so people speculating that testnet usage leads to further incentives. But the answer is clear. If you see KPIs and metrics being touted as part of testnet usage for a new project that's coming up, that's ready to raise a bunch of venture capital, they've done all sorts of really impressive things, it doesn't necessarily matriculate into real on-chain usage. We still have to look at the fundamentals that come next. The next is something that we're coining ourselves, I think. And keep me honest here. If anyone's discovered this and they've talked about it, feel free to yell at me from the crowd and say, hey, Kevin, this isn't necessarily original research. But we're calling this the 11 trade rule. And the question is, what is it that makes certain users more likely to continue using a DeFi protocol than others? Retention is one of the biggest problems that most DeFi protocols have. And the 11 trade rule is actually something we discovered that really helps with it. So what this chart is showing is the likelihood to continue using a protocol based on the early activity of a user on that protocol. And the more a user uses a protocol in the first 7 days of interacting with that protocol, the more likely they are to continue using that protocol long term. So much so that after they've used a protocol 10 times in the early usage of that protocol, they are somewhere between like 3.5 to 7x more likely to matriculate into being a long-term user. We saw this pattern actually across a huge number of DEXs and a huge number of DeFi protocols. Here we only have 2. But this also showed the only protocol that actually broke this trend was PancakeSwap on Binance, which I'm open to thoughts on why they broke that. But PancakeSwap has a lot of wallet rotation that happens for users. So it might mean that PancakeSwap has high retention, or it might be very heavily botted. Who knows? The last area that we're looking into is how does geography impact the trading trends? And then the question that everyone asks is like, who's driving the market? Is it America? Is it, is it China? Is it Singapore? Is it Korea? Is it Europe? We try to break it down just broadly based into Asia, Europe, North America. What we found is that the time of the day matters tremendously. And certain activities in certain time periods are much more likely to be successful than others. It's probably no surprise that Asia does most of its trading from 9 to 2 p.m. Singapore time. Europe follows a pretty similar pattern, and then America follows. What we found is that by using these patterns, you can optimize strategies around when to launch products, when to launch tokens, when to launch marketing announcements based on the geography that you want to target. So Projects that are targeting primarily US users from 1 to 5 p.m. Eastern time happen to be the most important time that they can find on chain. I'm running a little bit out of time here, so let me wrap up with my key takeaways. So first is that the median trade size that you see across protocols is very important. The larger the median trade size, the more likely it is that the activity on that protocol is organic, the less likely it is that it's botted, and the more likely it is that the activity for the average retail user is going to be profitable. The second is the 11 trade retention rule. The more a user uses a protocol in the first 7 days of interacting with it, the more likely it is that they will turn into a permanent user. Third is that when in doubt, use Ethereum. Ethereum, across all metrics that we're tracking, has proven to be the least botted and the most common source of organic activity. And last but not least, to end on a high note, is that discount testnet by 95% is a general rule of thumb when you're trying to imagine like how much of this testnet usage actually matriculates into real world usage. On that note, I'll wrap it up. This is where you can find us, Jpeg Trading. My name is Kevin March. That QR code takes all of your crypto. I'm kidding, it goes to our Twitter account where we will post this presentation and all of our data from it. And anyone is more than welcome to come join us and comment on it. So thank you very much.